Welcome back again to our channel, your go-to hub for mastering the world of finance and fintech, and empower you to make smarter money moves in the digital age. In this episode, let's dive into how credit scores work and how to improve them. Your credit score is a number that represents your creditworthiness. Basically, how likely you are to repay borrowed money. Lenders, banks, and even employers use your credit score to assess risk and determine whether they'll lend to you and at what interest rate. How credit scores are calculated. Credit scores typically range from 300 to 850, with a higher score indicating better creditworthiness. The three main credit bureaus, Equifax, Experian, and TransUnion, calculate scores based on the following factors. 1. Payment history, 35%. This is the most important factor. It shows whether you've paid your bills on time, including credit cards, loans, and mortgages. Late payments, defaults, and bankruptcies can negatively affect your score. 2. Credit utilization, 30%. This refers to how much credit you're using compared to your credit limit. It's best to keep this ratio below 30%. High balances relative to your credit limit can signal risk to lenders. 3. Length of credit history, 15%. A longer credit history is beneficial. Lenders prefer borrowers who have shown they can manage credit over time. This includes the average age of all your accounts and how long it's been since you used each account. 4. Types of credit used, 10%. A mix of different types of credit accounts, credit cards, mortgages, auto loans, etc. is favorable but not essential. Having a variety of credit types can show you're capable of managing different responsibilities. 5. Recent inquiries, 10%. When you apply for new credit, it results in a hard inquiry on your credit report, which can temporarily lower your score. Too many inquiries in a short period can suggest that you're financially unstable or taking on too much debt. How to improve your credit score. Improving your credit score takes time, but following these steps can help. 1. Pay your bills on time. The most important step is making timely payments on all your accounts, including credit cards, student loans, and mortgages. Set up automatic payments or reminders to avoid late fees and negative marks on your credit report. 2. Reduce credit card balances. Lower your credit utilization by paying down your credit card balances. Ideally, keep your utilization below 30% of your total credit limit. You can also ask for a credit limit increase without increasing your spending to help reduce your utilization ratio. 3. Don't close old accounts. Closing old credit accounts can reduce your available credit and shorten your credit history, which can negatively affect your score. Keep older accounts open even if you're not using them, but avoid accumulating unnecessary debt. 4. Avoid opening too many new accounts. While it might be tempting to open new credit accounts, too many inquiries in a short time can harm your score. Space out credit applications to minimize the impact on your score. 5. Dispute errors on your credit report. Regularly check your credit report for inaccuracies or outdated information and dispute any errors. You're entitled to one free credit report annually from each of the three major bureaus through annualcreditreport.com. Managing or paying off debt, credit cards, student loans, and mortgages. Managing and paying off debt is essential to improving your credit score and achieving financial freedom. Let's break down strategies for handling common types of debt. 1. Credit cards. Credit cards are a common source of debt due to their high interest rates. Managing credit card debt is crucial for both your financial health and your credit score. Strategies for managing and paying off credit card debt. Pay more than the minimum. Always pay more than the minimum payment to reduce the principal balance and avoid high interest charges. Pay off high-interest cards first. Use the debt avalanche method. Pay off the credit card with the highest interest rate first while making minimum payments on others. This minimizes the amount you pay in interest. Balance transfers. Consider transferring high-interest credit card debt to a card with a lower interest rate or a 0% introductory APR to reduce interest payments and pay off the debt faster. Be mindful of transfer fees. Avoid new debt. Once you start paying down your balances, try to avoid accumulating more debt by limiting unnecessary purchases. 2. Student loans. Student loans are another common form of debt, often with lower interest rates than credit cards, but still significant. Managing student loans effectively can prevent them from becoming a burden. Strategies for managing and paying off student loans. Understand repayment plans. There are different repayment options, including standard repayment, graduated repayment, income-driven repayment, IDR, and extended repayment. Choose the plan that best fits your financial situation. Refinance. If you have good credit and steady income, you may qualify for refinancing your student loans at a lower interest rate. This could save you money in the long run. Pay more than the minimum. If possible, make extra payments to reduce your loan balance faster and pay less interest over time. Loan forgiveness. Some student loan programs, like Public Service Loan Forgiveness, PSLF, offer debt forgiveness after a certain number of years of qualifying payments, so make sure you know if you qualify. 3. Mortgages. A mortgage is usually one of the largest debts people carry, and it's essential to manage it effectively to avoid foreclosure or financial strain. Strategies for managing and paying off your mortgage. Make extra payments. If possible, make extra payments toward your mortgage principal. Even small amounts can significantly reduce the amount of interest you'll pay over time. Refinance your mortgage. If interest rates have dropped since you took out your mortgage, refinancing might lower your monthly payments and save you money in the long term. Consider a bi-weekly payment plan. Instead of making monthly payments, try making half of your monthly payment every 2 weeks. This strategy can help you pay off your mortgage faster without much strain on your budget. Avoid missing payments. Missing mortgage payments can seriously damage your credit score and may result in foreclosure. Set up automatic payments to avoid late fees and protect your credit score. Final thoughts. Staying on top of debt management. Debt is a normal part of financial life, but it's important to manage it wisely to avoid falling into a cycle of financial stress. Here's a quick summary of the key strategies. For credit cards, pay off high-interest balances, keep utilization low, and avoid opening too many new accounts. For student loans, understand your repayment options, consider refinancing if eligible, and pay more than the minimum. For mortgages, make extra payments when possible, explore refinancing options, and set up automatic payments to avoid missing deadlines. Improving your credit score and managing debt requires a combination of discipline, planning, and consistency. By implementing these strategies, you can steadily work toward financial freedom, reduce the burden of debt, and build a stronger credit profile over time. If you found this video helpful, don't forget to like, subscribe, and click the bell icon for more finance tips. And if you have any questions about how credit scores work and how to improve them, drop them in the comments below. Thanks for watching, and I'll see you in the next video.